Hi everyone, Jonathan Gengle, Financial Advisor here at Bayntree Wealth Advisors with your monthly 401k webinar here in July of 2022. We're going to be talking about consequences of cashing out your 401k. We've seen pretty unprecedented mobility in the workforce in the last year, really. So a lot of people may be looking at new positions, moving into new job roles. What impact does that have when you have to elect an option with your old 401k? What are the benefits and drawbacks of these different options? So going through just some scenarios here that you might be able to use to help make a good decision if you find yourself faced with that particular decision and what options are available to you. As always, your team here at Bayntree is dedicated to assist you in any facet of financial planning, so pertaining to your employer-sponsored plan, but also outside of the plan if you have questions on how to really personalize and do some specific planning. Legal disclosure, we're going to talk about some hypothetical scenarios today. Again, what options are available to you in the circumstances of cashing out your 401k specifically. Don't make any moves. Don't do anything without speaking to us, or if you have another financial or tax advisor as well, to really get sound advice. So the agenda for today, while looking into this topic, we're going to look at, like I said, really the last year, what's been labeled as the Great Resignation in the American workforce, options for your old 401k if you're resigning, moving into a new position, going with a new employer, and then looking at one of those options specifically, which is cashing out your 401k, and we're going to dive into that one a little bit deeper. What are the consequences of doing that, doing a kind of a real world scenario? So first in that agenda, the Great Resignation. So we've really seen this unprecedented shift in the American workforce, really was set off by what happened in the pandemic. So there was a lot of changes, a lot of updates to how the average worker really engaged with their job. You know, many people were forced to work from home. That's added to new flexibility, caused individuals to question maybe those old roles that they were in and look for better opportunities, maybe in different fields or even in the same fields with more flexibility. So this graph here just shows really what we've seen in terms of that shift and that movement of the workforce in terms of resignations and moving into new roles. You can see 33 million Americans had quit their jobs as of, that was the spring of 2021. So really an unprecedented movement in the American workforce. With that being said, that means that many individuals, many workers may be leaving an old employer-sponsored retirement plan behind. What do you do if you're in that situation where you're moving jobs? You had a 401k or a 403b, or even, if you're lucky, some sort of pension plan. What options are available to you in those circumstances? So here's a list of them. What you're eligible to do when resigning from a position. So you can, if your new employer offers, say, a similar 401k plan, you can simply roll over that old plan into the new plan. You could roll it over into an IRA if you're looking to maintain tax deferral and maybe get a little bit more control. There are some specific steps you have to take to make sure that you're not paying taxes on that distribution, that you are doing a qualified rollover into an IRA. You can also convert to a Roth IRA, which please, seek guidance with a tax professional if you're considering doing that. You're basically taking pre-tax money or monies that you haven't paid taxes on yet in your 401k, paying them up front and getting them into a never taxed account moving forward. Generally, only a good idea if your balance is pretty low or if your income has dropped substantially, so you can absorb more of that tax hit and not pay too much in taxes at once. You can do nothing if your balances are over a certain amount. There's nothing that says that you have to move your money out into a new plan or an IRA. You can leave it in the existing plan and keep it there until you're ready to utilize it. And then the last one, which is generally and most often never a good idea to do, but that is to cash in your 401k. And so we really want to focus on that last option today so you can understand the consequences, because with this shift in workers and this movement, this mobility in the workforce, individuals might not know what job they're going into. They may have a lapse in their career where they might need some income, and they might feel that their only option is to cash in those funds. So we're going to go through why that's maybe not a good idea. So here are some consequences of cashing out your 401k. So really, if it's a very low dollar amount, or if you have nothing else as a buffer to bridge that gap until you start making regular income again, you really don't want to touch that 401k. The reason being is anything that you take out that is pre-tax. So if you made those salary deferral contributions to your 401k and you were getting an income tax deduction, that money comes out. It is fully taxable to you at whatever your state and federal tax bracket is. So let's just say you worked for half the year and you made $50,000 and your 401k was 30 and you cashed it out. That adds an additional $30,000 of ordinary income to your taxes for the year. Additionally, if you are under 55 when you separate from your employer-sponsored plan and you take that money out, there's going to be an additional 10% pre-distribution penalty. There are some exceptions to that, but we're not really going to get into those today. Just assume that you're going to have to pay an additional 10% tax. Also, the distribution, the custodian of that account, they're mandatorily just going to withhold 20% in federal taxes. So at bare minimum, if you're under 55, bare minimum, you're going to be paying 30% in taxes on that distribution. So again, let's just say you had a smaller balance, 30,000 that you take out, you're going to be paying 30% taxes on that distribution. So you're basically $9,000 in taxes to get that money out. It could also, depending on how much income you've earned in a given year, could bump you into a new tax bracket, meaning you're paying even more overall taxes, and it can be kind of a nasty surprise when you go to do your taxes at the beginning of next year. So here's a real world scenario that we're going to look at too, just to maybe illustrate a little bit better. So take a look at these. I'm not going to necessarily get into the nitty gritty, but what we're looking at here, scenario 1 and scenario 2, kind of on paper the same type of worker. Worked for 10 years, earning 60,000. We're not going to assume any increase in pay or anything like that, just to keep things simple. But in scenario 1, that worker was contributing 10% of their salary to their 401k, so $6,000 a year, and it was earning 6% a year. Same for scenario 2. Here's where things get a little bit different. Worker 1 in scenario 1 leaves the job for a year, the job market, let's just say. So they leave their existing job, they're out of work for about a year. Maybe they didn't do enough planning to have emergency savings or a backup plan there. Their 401k, based off of their previous contributions and the rate of return, is worth just over $79,000. Same deal here on worker number 2 in scenario 2, same value, but they had done some additional planning to make sure that they were ready for this type of change. They don't take their 401k out to bridge that gap. What you can see here in the red on scenario 1 is for that worker to do that, they basically bump themselves into a new tax bracket. We're assuming they're a single filer for their tax purposes. They're going to pay approximately 33% or $26,000 to net out 52. So after taxes, what do they take home in their pockets? So they're paying a lot of money in taxes to get that money out. Not only that, it then puts them behind in their retirement savings plan. So what you'll see here is now we're going to look forward looking and say, okay, in this situation, they were able to get a new job. It took a year. They cashed out, bridged that gap. They're going to try and catch up now for that time lost and that money that they spent when they took out of the 401k. So they're going to actually get a pay bump now. They found a new job making $67,000. They say, okay, I need to catch up. I can afford to put 15% of my paycheck into the 401k, which equates to just over $10,000 a year. Same rate of return at 6%. We're going to say they're going to work for another 20 years. Same situation. with worker two and scenario two, but they don't increase their contributions. They don't need to catch up. They say, I'm just going to keep doing 10% into my 401k. They got a pay bump too, so they're only putting 6,700 a year away at that 6% rate of return. But remember, they didn't take that money out, pay the taxes, take that hit. The end of that full cycle, we're looking at 30 years. So at the end of this 30-year period, that employee in scenario one, because they took that money out, and even with trying to increase their contributions, they are going to have less money for retirement. You can see roughly $370,000, whereas employee two in scenario two is going to have just over $500,000 in their 401k because they address some of these planning points in advance. So very interesting, maybe a little bit simplistic. There are some other variables that go into it, but just to understand that time is your ally and also to be very cognizant of the tax consequences. So all the more reason to look at doing multifaceted planning in other areas and realizing, again, what the 401k is really designed for in terms of that retirement savings. So if you have questions on this topic, or if you have a specific situation that you find yourself in something similar to what we illustrated here, please reach out to us. We're here to help. We're really proponents of education and information, so don't feel intimidated to contact us. There are no stupid questions either. Just give us a call, send us an email. We would be more than happy to help. So we'll see you again next month for our next webinar, and I thank you for taking the time to go through this very important topic today. Take care.